Hey folks, this is your accountant Mansoor Sohail. I operate out of Toronto, Ontario, and my specializations are taxes for Canada and USA. My today's presentation is for educational purposes only. I will be talking about source rules for deductions. So, if a foreign person is only a passive investor in the United States, we do not need to source his income. His income is taxed on a gross basis through a flat rate withholding tax. If a foreign corporation has a branch office in the United States, it will be taxed on its net income effectively connected with United States. A US person's foreign tax credit limitation is based on the ratio of net taxable income from foreign sources to net income from all sources. In computing taxable income from sources within or without the United States, a taxpayer can deduct expenses and losses directly related to either US or foreign source gross income. Allocation. The first step in sourcing a deduction is to allocate it to a related income producing activity or class of gross income. Potential classes of gross income include compensation for services, gross income from a business, gains derived from dealing in property, interest, rents, royalties, and dividends. The allocation rules emphasize the factual relationship between a deduction and a class of gross income. Most deductions are definitely related to a specific class of gross income. Some deductions are related to all gross income. Let's take a look at an example. We have a USA corporation, which is a domestic corporation. It derives 800,000 of gross income from sales of services and 200,000 of gross income from product sales. USA corporation expenses include 500,000 of salaries paid to service technicians, 130,000 of salaries paid to product salespersons, and 100,000 of rent paid on its headquarters office. Because the rent expense is related to all the USA corporation's gross income, USACO allocates 80% of the rent expenses to sales and 20% to the product sales. Step 1 is to allocate deductions to a class of gross income. Compensation for services, gross income from business, gains from dealing in property, interest, rents, royalties, and dividends. Step 2, apportion deductions between US and foreign sources. Gross income, gross sales, units sold, cost of goods sold, profit contributions, expenses incurred, assets used, salaries paid, space utilized, and time spent. Apportionment. We have to apportion deductions between US source and foreign source income. Potential apportionment bases include gross income, gross receipts of sales, units sold, cost of goods sold, profit contributions, expenses incurred, assets used, salaries paid, space utilized, and time spent. Example. USA Corporation is a domestic corporation that sells its products both in the United States and abroad. During the current year, USA Corporation had 10 million of sales and a gross profit of $5 million and incurred 1 million of selling general and administrative expenses. USACO's $10 million of sales includes 6 million of foreign sales and 4 million of domestic sales. On the other hand, because USACO's domestic sales generally involved higher margin products than its foreign sales, USA Corporation's gross profit of 5 million was split 50-50 between USA and foreign sources. So if USA Corporation uses gross profit as an apportionment base, it would apportion $500,000 of SG&A expenses to foreign source income, that is 50% times 1 million of SG&A expenses, as opposed to 600,000 if gross sales is used as an apportionment basis. USACO customers sales equals $4 million. Gross profit is $2.5 million. SG&A is $1 million. Foreign customers sales is $6 million. Gross profit is 2.5 million. The election of an apportionment base also is impacted by the type of records that the taxpayers maintain. Let's look at an example. The fact in this example are same as in the above example, except that now assume that USACO's SG&A expenses of $1 million consist of the president's salary of $250,000, the sales manager's salary of $100,000, and other SG&A expenses of $250,000. The sales manager's salary of $100,000 and other SG&A expenses of $650,000. Also assume that USACO's president and sales manager maintain time records, which include that the president devoted 30% of her time to foreign operations and 70% of the domestic operations, while the sales manager devoted 40% of her time to foreign operations and 60% of the domestic operations. USACO should now apportion the salaries of the president and sales manager on the basis of time spent and apportion the other SG&A expenses on the basis of gross profit. Therefore, USACO's apportions to foreign source income $75,000 of the president's salary, which is 30% of 250,000. 40,000 of the remaining SG&A expenses, that is 50% times 650,000, for a total of 440,000 of SG&A expenses apportioned to foreign source income. So now USACO, we have US customers sales equals 4 million, gross profit is 2.5 million, SG&A is 1 million, president's salary 30% of foreign is equal to 250,000 and manager's salary 40% of foreign is equal to 100,000. Other SG&A is 650,000. Foreign customers sales is 6 million, gross profit is 2.5 million. Let's talk about interest expenses. Let us assume a USA corporation arranges a second mortgage on its factory in the United States and uses the proceeds to buy an office building in a foreign country. Interest incurred on these funds is related to all the taxpayers' activities and property will be allocated to all the taxpayers' gross income. Interest expenses apportioned between US and foreign sources income using the relative basis of US and foreign assets as an apportionment basis. For example, if 20% of taxpayers' assets are foreign in nature, then that taxpayer must apportion 20% of its interest expenses to foreign source income. The asset figures for a taxable year are the averages of the adjusted basis at the beginning and at the end of the year. A taxpayer may elect to apportion interest expenses on the basis of the fair market value of its assets. Taxpayers may also elect to use the alternative tax book value method, which allows the taxpayer to depreciate its US assets using the same alternative depreciation system that applies to foreign assets. Research and experimental expenses. The rules for research and experimental expenses provides that the taxpayer must generally apportion the entire amount to the reduction for R&D expenditures imposed by a government, that is legally mandated R&D, to that jurisdiction, that is US or foreign. Deduction for non-legally mandated R&D expenditures are apportioned between US and foreign sources using the sales method. Under the sales method, if more than 50% of R&D activities are performed in a single geographic region or source, US or foreign, 50% of deductions are for non-legally mandated R&D are exclusively apportioned to that source. Members of an affiliated group of US corporation must allocate and apportion R&D deductions as if all the members of the affiliated group were a single corporation. Losses from disposition of stock and other personal property. Losses from the sale or other disposition of stock and other personal property are generally sourced under the same rules that apply to gains from such property that is based on the residence of seller. Other specialized rules. Legal and accounting expenses. Legal and accounting expenses incurred with respect to a specific property or activity are allocated to the gross income produced by that property or activity. On the other hand, the cost of general legal and accounting functions is allocated to all gross income and apportioned on the basis of gross income. State income taxes. State income taxes are allocated to the gross income on which the taxes were imposed and apportioned on the basis of gross income. Net operating losses. A net operating loss deduction allowed under Code Section 172 is allocated and apportioned in the same manner as the deductions, giving rise to the net operating loss deductions. Stewardship expenses attributable to dividends. Expenses associated with stewardship activities are allocated to the class of gross income that includes dividends received from that subsidiary. Standard deductions. The standard deduction is allocated to all the individual taxpayers' gross income and apportioned on the basis of gross income. Certain personal expenses. An individual taxpayer's deductions for real estate taxes on a personal residence, medical expenses, and alimony payments are allocated to all the taxpayer's gross income and apportioned on the basis of gross income. Personal exemption. Personal exemption deductions are not taken into account for purpose of allocating and apportioning deductions. Charitable contributions. Charitable contributions are allocated to all the taxpayer's gross income and apportioned on the basis of gross income. Folks, I have prepared this lecture from Practical Guide to U.S. Taxation of International Transactions, written by Robert J. Massey, Jr. and Michael S. Shadewald, 9th edition, published by Walters Kluwer, CCH. Thank you for listening.